Good morning and welcome to Clear Path Retirement Radio. I'm Stewart Smith. I'm here with my co-host Mitch Davies.
Good morning.
And we are going to talk today about a topic that we talk about quite often with folks who are relocating to this beautiful area we live here in the upstate of South Carolina. And a lot of people ask, where is the best place to retire? But, you know, Mitch, what they're really asking is a tax question.
It is.
South Carolina is a very popular retirement destination, but you know, it's not tax-free. It's strategically tax-friendly. And what we're going to talk today about is how it is strategically tax-friendly. Say that real fast.
I can't.
And we'll talk about what makes it attractive and what's misunderstood about it. And so let's get into this, Mitch.
Yeah, I'm excited.
So the first thing that I will say that is helpful is there is no tax on Social Security in South Carolina.
That's huge.
So that is a big help to folks who are pretty reliant on their Social Security for their retirement. Yeah. And that is, that is strategically a wonderful thing for those folks to not have to worry about that part. But, you know, what I'm going to say is South Carolina in general is, you know, a very tax-friendly state, but you have to, you know, understand how to structure your income to make those tax benefits optimal.
You do. You know, there's a couple levels of state tax, and we're going to get into the more retirement-focused one today, but you've got, you know, everyone understands there's different sales tax in each state and different general expenses. You're going to have different property tax values and, you know, the general basic things that you look at. But Stewart, there's actually a couple interesting things we'll get into today that are specific for retirement. And like you said, structuring income. And you can get creative with these different rules. And I'm excited. This is going to be a cool one.
Yeah. So, you know, I think one of the things that isn't understood or isn't known really is that there is an extra retirement income deduction here in South Carolina that allows you to get a pretty nice deduction. I think it's about $15,000 per person per year coming off of the retirement income picture there. And it, you know, if it applies to IRAs, 401ks, pensions, things of that nature, and that is a huge help for folks down here in South Carolina and the upstate. And, you know, that can be extremely helpful to those folks who are relocating here from high tax states, and we see it all the time. You know, I think the last number I heard, Mitch, was 75 people a day.
I heard something similar.
Moving into Greenville, South Carolina area.
That's crazy.
We call home. And that is a lot of folks.
Yeah.
And I know that when we do our workshops and seminars, we get a lot of those folks that come because they moved here for the tax advantages and they want to understand how to make the most of the tax advantages that this state gives you. And again, that's kind of what we're going to talk about today. But, you know, it's really just, it starts with the foundation of just lower cost of living.
It does. Just lower overall costs.
I mean, we talk to folks all the time who are coming here from states like California and New York.
Right.
And, you know, it's night and day difference.
It's ridiculous.
I tell you, we're going to give you like some examples of how that would differ coming from those type of states today. And I can tell you that, you know, it is a different world. You know, you can retire with the same income, the exact same income, and come in those states or South Carolina, and you can live a completely different lifestyle.
Completely.
I mean, it is really interesting how that works. So, you know, I would say that, you know, so let's kind of go through it. Like, as far as property taxes go, there is, you know, South Carolina is pretty reasonable.
They are. That's one of the first ones we hear. When people come down, you know, move here, and they're like, look, I was paying on the same house, I was paying 3-4 times as much just to live there, you know, and that's one of the main draws to, you know, the Southeast and that sort of thing. It's one of the first things people look at.
It is, and you know, a 4% assessment ratio on your primary residence here is pretty sweet.
Solid.
You know, 6 on, you know, those you know, non-primary residents, you know, vacation homes and things of that nature, second residences. But that 4% can be very, very attractive for folks who are paying, like you say, 2-3 times that in other high tax states. And not to mention that once you hit 65, you can qualify for the homestead exemption here.
Yeah, it's a big deal.
Yeah, the homestead exemption is a big deal because that knocks, what is it,
50,000
off of the tax value of your home. And so that even reduces the property taxes even further. So, hey, you know, for someone on a fixed income, predictable housing costs matter just as much as income taxes.
They do.
So, you know, that can be a big deal. You know, as far as legacy planning here too, you know, we do a lot of legacy planning. Like we've said many times, we do a lot of trust for folks to help them avoid probate, and help simplify things for their family. And, you know, it's really nice to know that there's no estate tax here, no state estate tax, there's no inheritance tax.
Right.
And it makes, you know, wealth transfer much simpler and easier than most states.
It does. This is something you really got to think about, and I think it has a huge factor in why so many people end up retiring into a state like this. We're working with the client right now. She's getting ready to move up to Washington, the state of Washington. And they, you know, the federal estate tax exemption is so high, it's not really a factor for the majority of Americans these days, but Washington in particular, again, for example, has a state estate tax of exemption of only a couple million. So anything over that, you're subject to a state estate tax. And those estate taxes get hefty. I mean, you're talking 30-40%. So when you have a state like this where there's no state estate tax, it just opens up a ton of planning opportunities.
Right. You always got to deal with that federal estate tax, but it's nice to live in a state that doesn't add to that with state estate tax. So yeah, that's a great thing. And, you know, if part of your plan is to take care of the next generation, this kind of stuff matters.
It's huge.
It matters more than people realize. So, you know, the next thing I want to talk about is, you know, is that state income tax. So it's not zero here. It does exist. But it's, you know, it's not a terrible state tax here, income tax, and it's, you know, when you compare it with the lower cost of living and all the other tax benefits you get here, it's really not a problem.
It's not.
And, you know, I know that they're making moves, and the state Congress has moved to lower that more and more, and I think it's right around 6 right now. But they're trying to push that down over the next few years and get it even lower. So yeah, again, in the general landscape of taxes in South Carolina, that's really a small price to pay for all of the other advantages and benefits that you get. So, you know, let's press on here. I would say that South Carolina is obviously very tax friendly, but one of the things I will say about South Carolina is you have to understand how to structure your income in South Carolina to really optimally benefit, again, from the tax structure that we have here. We have, you know, some really interesting you know, deductions and things of that nature, but it also really depends on exactly where you're pulling that income from. So when it comes to like withdrawal order in South Carolina, you have to be really cognizant of how the tax laws are structured here to optimally benefit from it. And that takes planning.
It does. You know, I like to say exemptions create opportunities, right? And when you've got, you know, the government will always rather add an exemption than just reduce the taxes overall. Because when you have these different exemptions, when you've got some just for pre-tax money and some for over 65, you've got all these different exemptions that are available. If you don't strategically plan for them, you're probably leaving them on the table. You're probably not taking things in the correct order that's going to allow you to take advantage of these exemptions. So it's extremely important to, A, have a plan that's going to outline how can we maximize this? If you're moving into South Carolina from a higher tax state, how can we shift that income picture to make sure we're being optimal for South Carolina? And how can we make sure we're utilizing all these? Because this landscape changes every year. I mean, we've seen senior deductions just get added in the past 12 months that have changed the landscape of retirement planning. We see this constantly, and what we're doing every day, Stewart, is monitoring this environment so closely. So it's so critical to have a team around that's focused on what has become so important in tax planning.
And it's so important to understand that in the planning piece of it, because your CPA, your tax professional, they're great, and they are great at preparing taxes and getting you deductions and that sort of thing. But when it comes to planning and understanding the landscape and really understanding how to structure things from a long macro planning, perspective, then it's you need a planner who really gets this stuff and really understands it. If you have moved here from a high tax state and you're wondering if you are getting all the benefits you possibly can from living in a state like South Carolina, go to our website, clearpathretirement.com. Give us a call, 864-775-5033. And we'll have a discussion. Let us take a big picture look at what's going on with you tax-wise, and let us see if we can get you a little more optimal. Welcome back to Clear Path Retirement Radio. I am your host, Stewart Smith. I am here with Mitch Davies.
Welcome back.
Today we are having a discussion on what are the tax advantages to retiring to a state like beautiful South Carolina where we make our home. We are a local upstate firm here in Greenville, South Carolina. We are two native South Carolinians that have founded a firm. We are also veteran owned and operated here in Greenville. And what I would say is I'm going to give you some examples here. I think examples are a great way to illustrate, what that kind of looks like as far as if you are coming from a high tax state. And in this first example, we're going to go with California, one of the highest tax states in the country. And we do get quite a few folks that move here from California.
Yeah,
that's,
definitely.
Very, very common. And so, let's take a married couple. They're both age 67. Let's say their Social Security together is about $40,000 a year. And then to get the income that they want in retirement, they need to take about $60,000 combined IRA withdrawals from their IRAs, giving them roughly a gross of about $100,000 a year. And then let's say they own a home here of about $700,000. So, in California, Social Security is not taxed, same as South Carolina, but the IRA withdrawals are fully taxable at the state level. And that can be up to 9 to 10% effective rate depending on bracket. So we're going to estimate the state tax on the $60,000 of IRA withdrawals to be somewhere between $3,000 and $5,000 annually. And then property taxes are going to run, 1%, maybe a little more there, which is about $7,000 annually in property taxes. So let's compare that to South Carolina with the same income. So like we said, Social Security in South Carolina is not taxed, but the IRA withdrawals are treated differently. So the first $30,000 on the IRA withdrawals is largely offset by retirement income deduction that you receive here. There's probably some additional age-based deductions that will reduce that taxable income further, just depending on where you're taking that from. But the state tax on the IRA could drop to near zero or very minimal on that. Your property taxes on a primary residence is going to be taxed at a much lower rate than California. So potential reduction to $2,000 to $3,000 range, depending on specifics. So, you're going from $7,000 a year in property taxes down to potentially, $2,000 a year there. And you're not paying the 9 to 10%, state tax on the withdrawals from the IRA.
It's huge. I mean, even that alone, you compound that over 10 years of time, and we're talking $30,000 in state tax saved just on a simple move.
So, when in that example, and that's a pretty real example.
It is.
There,
it is.
You would have paid, if we had $40,000 that we needed from the IRA, you'd have paid potentially, $4,000 on that.
Yeah.
And then you reduced your property taxes by, another $5,000. I mean, we're talking about close to, in that $8,000 to $9,000 range per year in taxes saved, and just by relocating.
Simple as that.
And I mean, think of the impact over a 30-year retirement. We're talking significant money, and not to mention that, if you don't have to spend that money, you can keep that money, invested, keep that compounding, keep offsetting inflation with that money.
Right.
You could do a lot of things. You could take a very nice vacation every single year with that kind of money in savings. So, that's pretty significant there. So let's talk about the other big tax state that we see people come from, and that is the state of New York.
Of course.
New York is a very high tax state as well.
It's a whole different world from what we're doing here. It's crazy. Yeah.
And, let's say we have we're going to give a little different example for New York. Let's say we have a married couple, they're both age 68. They get about $50,000 in Social Security, and they have $80,000 in pension and IRA income. So the combined income from their pensions and IRAs that they need is about $80,000 a year. And let's say they own a $600,000 home. So that's the parameters we're going to set here. So in New York, Social Security is not taxed as well, but the pension and IRA is treated differently. There are some exclusions that exist, but much of the $80,000 is still taxable. So the estimated tax will be somewhere in that neighborhood of $4,000 to $6,000, depending on how you structure it. And then property taxes in New York, would be on a $600,000 house would be in that $8,000 to $12,000 annually, depending on what county you're in.
Yeah.
So really high property taxes up there. So, what we would see here in South Carolina is the Social Security, of course, is not taxed as well. The retirement income deductions would be reduced by $30,000 immediately, so that would get excluded immediately. And then the additional age-based deductions reduce taxable income even further. So what happens is a meaningful portion of that $80,000 becomes shielded.
Yeah.
State tax liability drops significantly, often by several $1,000s, and property taxes would be cut by 50% or more depending on where they're located in South Carolina. So, we're looking at, again, same type of scenario, probably reduction in overall state taxes, overall taxes, period, and living in South Carolina as opposed to New York, are probably in that, $8,000 a year plus range, depending on the exact circumstances. So, it's really with New York, it's the property tax thing.
It is, and it's interesting. These higher tax states often have, that's just the state level. Often, like he mentioned, the county and the city specific taxes are ridiculous. For example, I recently spent some time in Chicago, beautiful city. Illinois has higher state taxes, not like New York, but it's a little higher. But then in Chicago in specific, when you're within their city limits, you get an extremely high Chicago tax on top of the Illinois state tax, on top of federal tax. So these states like New York, California, Illinois, with the higher taxes in general, also have these very high county, city-specific taxes that end up stacking on. And that carries across everything, into property, into sales, into gas, into the roads, into the entire, economy of the city. So these impacts can be really felt when you move here, and you'd notice that just a whole reduction in the taxes.
Absolutely.
Yeah.
And that's why we see it.
Yeah.
We see it day
Yeah.
in and day out, people coming here because, in both of these cases we mentioned, the income didn't change, the environment changed.
Yeah.
And that's real opportunity, aligning where you live with how your income is taxed.
That's huge.
And for a lot of folks who are, worried about taxes in retirement, coming to a state like South Carolina can help drastically reduce that anxiety and what kind of taxes you're going to be responsible going forward. And people understand that.
They do.
And
they
they're
do.
coming here in droves because of that. And so, we welcome them, and, we definitely appreciate them coming here and helping us to grow and build our infrastructure here. And we want them to be part of the community, and we welcome them in. And if you have moved here from a high tax state to alleviate some of that anxiety about taxes, but you're still not sure that you have structured your income to benefit from in the most optimal way from the tax incentives and tax structure that we have here in the beautiful state of South Carolina, go to our website, clearpathretirement.com, click that Get Started Today button, and let's set up a time to just have a conversation. No pressure. Let's sit down and talk. Let my team and I take a look at what you're doing, how you're structuring your withdrawals, what income you're tapping into, to make sure that we are, doing that the most optimal way to take advantage, because, taxes are a real issue in retirement. Tax control is a major thing that you need to be focused on in retirement, and we help our clients really optimize their tax structure, optimize their withdrawal order, and we help, every dollar that you get to keep in retirement and not paying taxes is a huge deal. And so we believe that, and that's why we're a planning first, firm. We do the plan, and we worry about, all kinds of strategies to help reduce those taxes, whether it be Roth conversion strategies, tax loss harvesting, all of the various strategies that we put in place to help you to make sure that you're doing all these things the right way. We are having a great discussion today.
It's a good one, man.
A lot of
It's a good one.
And we'll be right back in the next segment. Again, if you'd like to talk with us, clearpathretirement.com, 864-775-5033. Welcome back in to Clear Path Retirement Radio. I am Stewart Smith. I'm here with Mitch Davies, my co-host, and we are ready for the segment we do every week called Mitch's Market Minute, and we are ready. Mitch, let's talk.
I'm excited, Stewart. As always, this is my favorite segment, personally. We've got a ton going on in the markets these days, and it's nice to just spend a minute talking about what's going on, the kind of stuff we're telling clients every day. We're trying to, again, we're retirement planners, so we're focused on helping make sure that people are navigating through that phase of life correctly. And a lot of that, especially in times like this, is just talking people through, hey, there's a lot going on, but what does that realistically and historically look like? Because a huge part of our job is to understand the history of the markets and understand that how things like this impact the market. So let's spend a minute talking. First, as we always do, we're going to start at where we're at overall. The S&P still a bit down from all-time highs. We're sitting at right around 6,500. The NASDAQ right at about 21,006. So both of those are about 6 or 7% down from all-time highs, which we hit at the beginning of the year. And a lot of that has to do with oil. We talk about it every week, but it's the most important thing right now is oil prices are elevated. That Strait of Hormuz over there, just south of Iran, is still closed, and seems like things are working through that. We're probably getting closer to that getting opened. It seems like more NATO countries are starting to shift focus into that, and hopefully that gets open and oil prices are able to get back down. I know you've probably been driving by the gas station and seen, at least here we're seeing $3.70 for a gallon of gas, which is much higher than it was 3 months ago. So, and what we've seen is when things like this happen, oil prices and the stock market trade inverse. Generally, there's not much correlation there. Generally, we look at assets and how they're correlated. And what that means is when one goes up, the other one goes down. And oil generally doesn't have much correlation to the market. But in times like this, when the Middle East area has a huge production area for oil, and when there's straits being blocked off and energy centers being attacked, a lot of things going on, it tends to be a negative correlation to the stock market, and that's what we're seeing. So when we see oil prices rise from 60 a barrel to, they eclipsed over 110, 120 a barrel, we see the stock market take a hit. And what that means is volatility is higher. What that means for you is that when these things are happening and people are worried about the price of oil, they start selling off assets. Now, I want to spend a minute talking about what does this look like historically? Like I said, a huge part of our job is to understand the stock market history. And, patterns in the stock market and political tension, and these things we have a lot of data. We have a lot of history on since the stock market's open, we've seen world wars, we've seen pandemics, we've seen things that have really, really escalated into dramatic fashions. And we're able to go back and study what that means. And, the first thing I want to talk about is the S&P 500. Everybody knows what this is. Super simple. It's 500 companies that are handpicked to represent the market overall throughout different sectors of the economy. And a huge indicator, we look at charts, we look at stock charts, and a huge thing we look at is if you look at the weekly chart on the S&P and you look at the 200-day moving average, this is just an average price over, 200 days. And when the weekly chart on the S&P crosses under the 200-day moving average, historically, that's an extremely good sign. It's an extremely good buying opportunity. And what that means is we're seeing a lot of great companies go trading at a cheaper price, is really all that means. And every time that's happened, interesting history on that is on average, in the next 6 to 12 months, after we see that crossover, which we're seeing now, we've only seen 5 times in the last 25 years. We've seen, in the next 6 to 12 months, we've seen a 6 to 8% return. In 12 months after that time, we've seen 10 to 15% returns. The last time we saw this was last year when the Liberation Day tariffs were announced. And from the bottom in April to 2 months out from there, we saw 30% gain on the S&P. So what that tells us is it's an extremely, a huge gain. And what that tells us is these reactions are often V-shaped recoveries, right? We see dramatic headlines, we see heightened fear, but then the second it gets resolved, whatever it is, and in this case, it's conflict in the Middle East, we see a huge influx of buyers because historically, especially the U.S. markets have dominated, especially over the last 25 years. Returns in U.S. stocks have been so substantial that the second these things resolve, we see influx of buying come really into the market. So what that means for you and what that means in retirement is if you're working with us, for example, and you're allocated safely ahead of time, you understand that there's going to be a little bit of fluctuation, but you're not freaking out because you understand that we have the history to say that when we see these dramatic dips, it often recovers really quickly. And what we're telling clients all the time right now, it's extremely important in times like this, is, hey, there is a lot of volatility and the dips feel violent, right? We're really only down 7 or 8% on the S&P for the year, which isn't anything insane. We saw that for an entire year and a half in 2022 going into 2023. We were down 15%. But when there's big headlines, when there's news events, it feels so dramatic. And you get on the news and you see the breaking news and then you look at your portfolio and it's down and it's like, oh my, it feels so heavy. But what we've seen is these events are great buying opportunities, and we see really quality companies selling at good prices. So what I would challenge you to do is look at your allocations. You want to be in retirement. This is why we always talk about the bucket strategy. We always come back to the 3 bucket strategy. If your retirement income portfolio is set up correctly, you've got a buffer of money to live off of for the next few years that isn't affected by the market, you're not going to worry too much when these events happen. So that's always the way we come back to how we structure retirement income in general, is those three different strategies. And so I would challenge you to, take a look at your portfolio. And if you're just 100%, if you're in retirement and you're 100% just invested in the S&P 500, and you don't have a strategy, you don't have a clear bucketed plan, you're going to feel more fear. It's going to feel more heavy. So I would challenge you to take a look at that. And if you have never taken a look at a different structure, give us a call. We'd be happy to walk you through that.
Yeah, and the first thing that this brings to mind, Mitch, when you say, and all of this is great information, but the first thing that comes to my mind is tax planning. Mm-hmm. We're talking taxes today, and, what is the best time to look into doing a Roth conversion?
Times like this.
When markets are down.
Yeah.
And, we said markets are down right now, 6 to 8% in that range. And, so would it make sense to, while markets are down, to go ahead and convert some of that pre-tax money that you've been saving in IRAs and 401ks and 403bs and such, to go ahead and convert that into a Roth account, where when the market does recover, and we both feel like it's going to recover later this year.
History tells us it will.
That it recovers in a tax-free environment.
Right.
Where you're getting that recovery of, 6, 8, 10% in tax-free account as opposed to a taxable account. We talk to clients all the time, and I would, I like to use the slinky analogy.
Yeah.
Right? Like, when the market's down, it's like that slinky being compressed, and if you do a Roth conversion while the slinky's compressed, you're converting the same amount of shares. They're just worth less right now, right?
Yeah.
But as tend to happen in markets that are down, they tend to recover eventually. And when they do recover and expand, that slinky expands again, it's expanding in that tax-free environment, which is so beneficial for you to really maximize the tax benefits of that Roth conversion.
It's huge.
And so if you can do a Roth conversion while the markets are down, if you're considering a Roth conversion and you're just not sure when and how to time that thing, now's the time.
Now is absolutely the time. If you just, let's walk through a quick hypothetical of what that could look like. Let's take scenario A, where you don't understand this stuff. You don't understand the history, and you're like, oh my gosh, there's a lot going on. Let's sell out of this. Let's sit on the sidelines until everything's all the way back up. Let's play it safe, which is great. You sell out, you're playing careful. We see that V-shaped recovery, because again, a lot of these, what history tells us is a lot of these gains come at the beginning. So you don't want to miss that whole move. So let's say you do. Let's say you sell out today, and over the next few weeks, this all gets resolved. We see a big push up. And then later in the year, when the market's back at all-time highs, if it was, then you say, okay, what if I do a Roth conversion now? It's still probably going to be good, but let's take scenario B, where you use this time as, an advantage, and you convert some of that pre-tax money you've been sitting on, and you know you're going to have to take distributions on in a few years, that magic age 73 where you have to start taking money. What if we take some of that now and convert it over to the Roth and catch that big move of growth on the way up? That could be if we look at last year, that could have been 30% more money tax-free that you never have to pay taxes on. So would we do the whole thing? No. But if you haven't done it and you've been sitting on it and you need to do Roth conversions, everybody we talk to is like, yeah, I know it's something I probably need to do. I don't know, I'm waiting on, there's always some wait, right? There's always some, we're going to kind of see how things look next year. There's always a kind of unclear lack of urgency. And when there's times like this, it's a perfect time to almost have some urgency here and say, hey, this could be an opportunity to move some of that money over to a tax-free environment. If we have the bucket strategy and we're allocated correctly, we can afford to take some of that final bucket, that aggressive money, move it over to the Roth, and take advantage of that growth that, this is going to get resolved inevitably at some stage. And historically, we'll see some growth. Who knows if it'll be that 20, 30% number? I can't say for sure. But historically, we'll see some growth after this is resolved. We'll see markets, come back to life, and we'll see volatility decrease. So it could be a great time to take advantage of that.
Absolutely. And if you are, again, if you're contemplating a Roth conversion, you're a little worried, you're a little fearful of how to do that and making sure you do it in the right way, but you know that this could be a great advantage for you in retirement. And I mean, when we're talking, big gains in a tax-free environment, that can really change the retirement landscape for you. Give us a call. Give us a call. Come to our website, clearpathretirement.com. Give us a call at the office, 864-775-5033, and just schedule a time to just sit down and chat with our team and let us take a look at it. Let us model out these conversions for you.
Yeah.
Let us walk through what that could look like for you, what the tax advantages could be for you, because I'm telling you guys, don't procrastinate on this stuff anymore. It's time to look at it. It's time to take action, and we can do that with our team. We can take your hand. We can guide you through this, make sure that you're doing everything right, make sure that you don't, there's no missteps here, and that you're able to optimize your tax picture going forward. And it can change the entire landscape of what your retirement looks like and how successful you are in retirement and meeting the income goals that you need. So give us a call, 864-775-5033, or go to clearpathretirement.com and let's talk about how to help you. Welcome back into Clear Path Retirement Radio. I'm your host, Stewart Smith, here with Mitch Davies, as always, my co-host, and we are talking about retirement in beautiful South Carolina today.
We are. We're talking about, like Stewart said, we've got a lot of people moving here, and we welcome them with open arms. We love to work with people who are moving to the state, and we just want to make sure that people understand the different tax advantages. People always say, yeah, I moved here because of lower taxes. And that's half the battle, is understanding that. But there's a lot of, there's phase one of lower taxes, which is just the immediately realize you're going to pay less sales tax, you pay less income tax. But then there's that second layer, and that's what we've been talking a lot about today, which is this, it takes more planning to take advantage of. And we want to make sure that, if you move here for lower taxes, let's take advantage of as much of that as we can.
Absolutely. Let's not miss out on any opportunity we have to save money on taxes and be tax efficient.
That's right.
And, it's a lot of people move here because it's a beautiful state. We're right here in the foothills of the Blue Ridge and can be right up in the mountains here in 30, 40 minutes and some beautiful trails. I'm a avid hiker and just love this part of the state. And we work with a lot of folks here in upstate South Carolina, down in the Midlands, and then in western North Carolina as well. And if you've moved here and you wanted just a little bit slower pace of life, you wanted, a lower cost of living, you wanted just an easier life in retirement, you came to the right place.
Absolutely.
We absolutely love it here. We work with, hundreds of retirees here, making sure that they live the fullest, richest retirement they possibly can. And one way we do that is by helping them be as tax efficient in retirement as possible. And so it's a big deal, so we're going to let's recap a few of the major benefits here of living in South Carolina in retirement. And, one of those is definitely that we do not tax Social Security here. So that's one big one. And then the other is that we have this additional retirement income deduction that it can be extremely helpful to people. So for, an individual, it's about $15,000, and a married couple, that's $30,000. And just imagine that, $30,000 of your retirement income does not get taxed at a state level over 20, 30 years. That can be very significant to your retirement and what that overall picture looks like. But when you also combine that with the, much more reasonable property taxes than some of these high tax states are dealing with, that can be absolutely huge, Mitch.
It can. It adds up a lot. There's a lot of moving parts there, but even just looking at those two, it can mean $10,000-$15,000, over the course of a few years.
We have worked with countless folks that have coming here from high tax states like California and New York, and they're always really pleasantly surprised by the lower cost of the housing here,
Yeah.
the lower property taxes, the extra deductions that they get on their state taxes for that retirement income. All of these things add up so much for folks. And again, if you can reduce your personal taxes by $8,000 to $10,000 a year in retirement, I mean, that can be a beautiful trip that you can take every week with your every year with your family that you would not be able to take otherwise.
No.
And we see that. We see people doing that. And, it's a beautiful state that, it's the people here are friendly.
They are.
And welcome you typically with open arms. And so if you're thinking about moving here, if you're wondering what that could look like and you're in a high tax state, let us know. Let's work together to get you here and get you set up to where you've got a real plan to optimize the tax benefits that we do offer you here. If you've just moved here and you're wondering, am I getting the most benefit I can out of a very tax-friendly state like South Carolina, give us a call. Go to our website, clearpathretirement.com. Give us a call, 864-775-5033, and let's just have a conversation. Let's take a look. Let's sit down with my team and I, and let's look at the big picture for you. The first visit is absolutely free. We sit and talk and really get to understand what's going on and make sure we can bring some value to you. And we will, explain our process, the Clear Path retirement planning process that we use, and how that can benefit you and really get you on track. If you feel like you're off track and that you've lived here your whole life but you're not sure if you're on track, and you feel like that you have questions that aren't getting answered, give us a call too.
Let us walk you through this. Even like Stewart mentioned, even if you've lived here your whole life, what we can do is we're not going to just bring you in and say, yeah, taxes are lower, we'll save you some money. What we can do is we can walk you through what all the different benefits are, whether you've lived here your whole life and are unsure if you're taking advantage of what, even if you've lived here, you're probably not. There's so many different state deductions at certain ages. There's so much moving parts. So even if you've lived here, you might not be taking advantage of all this stuff. So let us walk you through a 3-5 year roadmap of here's exactly how much taxes you could save if you optimize things the right way. And I think once you see that number, once you see, hey, over the next 5 years, I could save $30,000 in state taxes by doing the same thing I'm doing, but just in slightly different order, in a slightly different way. Because what we find in retirement income planning is these small differences. And hey, let's draw from this account first, or hey, let's try to hold off on taking payment from this for an extra 3 months. It's these small changes that compound into huge results, because the tax system is designed to just catch you on passive activity. It's designed to just have you live life and hit you in ways that you're not thinking of, right? So if you're just intentional and you've got a real plan, we can show you over the next 5 years exactly what that looks like. And when you see that, people are excited. People are like, wow, this is money I would have just spent or not had or had no clue about. And it was right there the whole time.
Absolutely. I can tell you just from personal experience, I bought and sold sold a house and bought a new house here in the last year, and I was a little surprised that the 4% primary residence, rate that you get on your primary residence here, you don't just get automatically.
Right.
That is something you have to apply for and get approved for by showing them that that is your primary residence. And it's a little bit of a process, and I can't tell you how many people probably never do that.
Perfect example.
And are paying 6% when they don't need to be.
Perfect
and they
example.
Could be saving 2% a year on their property taxes and just never went through and followed through and got that approved for as a primary residence. And the other thing that we see, how many times have we seen people who have turned 65 and never got the homestead deduction because they never applied for it?
You mean, wait, sir, the IRS didn't give you a call and let you know? They don't let you know about this stuff? What?
So, I don't think they're not very helpful. That's not an automatic thing.
What?
And it's really it's really interesting because that's a $50,000 off the top reduction in the property value tax assessment wise.
Exactly.
That is going to really help reduce those property taxes even further. And if you don't have that, if you're like, I don't know what these guys are talking about, give us a call. Let's get you applied for that, get that approved for you, so you can start paying lower property taxes immediately. And it just never ceases to amaze me that people just aren't aware of these things. And so we're here to educate, we're here to teach you, we're here to guide you and make sure that all of these things are being done. And again, as far as the estate planning goes, what a friendly estate planning state we're in. And if leaving a legacy and that sort of thing is a big deal to you, then this is a great state to do, estate planning in. No estate planning, no estate tax here. Again, say that.
A lot of tongue twisters today, man.
And that's really important when it comes to leaving a legacy and making sure that every dollar that you have to pass to your heirs gets to them without Uncle Sam getting a big cut of that.
Yeah, and these are perfect examples of small changes that could take us 30 minutes to an hour. The 4 to 6% gap is huge. I mean, if you look at $1 million house, right? And you're talking about the difference between 4 and 6% every year, like that's stuff like that adds up so much. And these are the things, I joked about the IRS doesn't call you. Their job is to just collect. Their job is for you to figure stuff out, which you're probably not a professional at this, which, why would you be? And their job is to just collect and enforce. Their job is not to help. Their job is not to aid you in the most deductions you can. And if you're working with a tax professional, we love tax professionals. We love CPAs, all these things. A lot of times, they're just filing the taxes, right? And they're great. Some of them are extremely helpful. We work with some who are extremely helpful and proactive, but some of them are just going to collect the taxes and file them in the system, and that's all they're doing. So if you don't have any guidance on this, you could be missing out on thousands of dollars a year of savings that could really take 30 to 45 minutes to set up and could pay huge dividends.
Absolutely. And again, if you're wondering about this stuff, if you're just curious, like, am I getting that exemption? Am I paying 6% when I could be paying 4%? If you're wondering about these things, give us a call, 864-775-5033, or visit us at clearpathretirement.com. And set up a 15-minute call. We can do it that way, or you're welcome to come into our office and sit down with us and face to face, and let's have a conversation. Let's see how we can help you make sure you're being as tax efficient as possible in the big, beautiful state of South Carolina. Thanks for listening today. We will see you guys next time.
See you soon.